Hey everyone, welcome back to the Crypto Intelligence Portal with Covesting. I'm Nathan.
And I'm Liz. Today's topic, reading charts.
On a very basic level, stock or crypto chart patterns are a way of viewing a series of price actions which occur during a trading period. It can be over any time frame, monthly, weekly, daily, intradaily. Here are some basic patterns.
The pennant. A pennant is created when there is a significant movement in the crypto, followed by a period of consolidation. This creates the pennant shape due to the converging lines. A breakout movement then occurs in the same direction as the big price move.
The cup and handle. The cup and handle pattern gets its name from the obvious pattern it makes on the chart. The cup is a curved U shape, while the handle slopes slightly downwards. It always occurs after a clear uptrend in price, and in general, the right-hand side of the diagram has low trading volume.
Ascending triangle. This triangle pattern usually appears during an upward trend and is regarded as a continuation pattern. It can be created as part of a reversal at the end of a downward trend, but more commonly it is a continuation. Ascending triangles are always bullish.
The triple bottom. The triple bottom pattern is used in technical analysis as a predictor of a reverse position following a long downward trend. It occurs when the price of a crypto creates three distinct downward prongs at around the same price level before breaking out and reversing the trend.
Descending triangle. The descending triangle is another continuation pattern, but with this triangle there is a bearish pattern. It is usually created as a continuation during a downward trend.
The inverse head and shoulders. The inverse head and shoulders chart pattern is used as a predictor for the reversal of a downward trend. It gets its name from having one longer peak forming the head and two level peaks on either side which create the shoulders.
Bullish symmetrical triangle. The bullish symmetrical triangle pattern is easy to spot thanks to its distinctive shape, developed by two converging trend lines. This pattern occurs after an uptrend and can be made by drawing trend lines that connect a series of peaks and troughs. The trend lines create a barrier, and once the price breaks through, a sharp movement in price follows.
The rounding bottom. This pattern is sometimes called a saucer bottom and demonstrates a long-term reversal in which the price moves from a downward trend to an upward trend. It can last any length of time, from several months to several years.
Flag continuation. The flag pattern forms within a rectangle. This rectangle is formed by two parallel trend lines, which form the support and resistance until the price breaks out. The flag will have sloping trend lines, and the slope should move in the opposite direction of the original price movement. Once the price breaks through the support or resistant lines, it will indicate whether it should be bought or sold.
The double top. The double top is a frequent price formation that appears at the end of a bull market. It appears as two consecutive peaks of approximately the same price on a price versus time chart. The two peaks are separated by a minimum in price. The price level of this minimum is called the neckline of the formation. The double top is completed and confirmed when the price falls below the neckline, indicating that further price decline is imminent.
Bearish symmetrical triangle. This pattern occurs after a downtrend and can be made by drawing trend lines that connect a series of peaks and troughs. The trend lines create a barrier, and once the price breaks through, a sharp movement in price follows.
Falling wedge. The falling wedge is a bullish pattern that begins wide at the top and narrows as prices move lower. This price action comes from a cone that slopes down as the highs and lows converge. In contrast to symmetrical triangles, falling wedges definitely slope down and have bullish biases. Once the breakout of the falling wedge is confirmed, it signals a buy.
Technical indicators can be found on charts above, below, and even directly on top of the price information. Indicators that use the same chart areas as prices are plotted on top of the price bars. They are called overlays.
Indicators are mathematical calculations based on price history and trade volume. They help forecast the future direction of the market. Technical indicators are a fundamental part of technical analysis and are typically plotted as a chart pattern to try and predict market trends. Last but not least, moving averages.
One final thing you can learn about when it comes to reading charts is the importance of moving averages. The MA helps smooth out price movements by filtering out the noise from random price fluctuations. It is a trend following or lagging indicator because it is based on past prices.
There are two commonly used moving averages. The simple moving average, SMA, which is the simple price average over a given period of time, and the exponential moving average, EMA, which gives more weight to the most recent prices.
The most common uses of MAs are to help identify the direction of the trend and to determine price support and resistance levels. While MAs are useful overlays of their own, they work best when combined with other indicators, such as the Moving Average Convergence Divergence, MACD. We won't get into the specifics of these in the video, but you can find plenty of examples online.
All right, everyone, we'll see you back here for the next episode at the Crypto Intelligence Portal.
Thanks for watching.